We hope the onset of the fall season is treating you well, as the final quarter of 2024 is well underway. Gains in U.S. equity markets have continued into the fourth quarter, and the widely followed S&P 500 index had increased 23% in 2024 through October 18th. And this followed a more than 24% gain in 2023. In fact, the S&P 500 has moved steadily higher for the past 2 years since establishing a market low in October of 2022. On October 12th of that year, the S&P 500 closed at a price level of just below 3,600 and was down more than 25% from its all-time high at the time of about 4,800. And because the peak to trough decline exceeded 20%, 2022 was a bear market. On October 18th of this year, the index closed above 5,800, and when the S&P 500 passed its 2-year anniversary from the 2022 bear market low this October, its increase was an impressive 64%. Since 1960, there have been 11 bear markets where we've seen a 20% or more decline, and that averages to about 1 every 6 years. Then on the upside, a bull market's declared when an index gains 20% from the low, but it often takes a while to surpass the previous index high. The current bull market from that October 22 low took about 8 months to rally 20%, and it was 15 months to exceed the pre-bear market high and go on to make a new all-time high. And as dramatic as the recent 2-year rally appears, again, it was up 64%, it was relatively in line with the average 2-year gain of 62% from the lows of all of those 11 bear markets. In all of those recoveries then, the index was higher after 2 years. The lowest increase was still 38%, and the 2-year gain exceeded 90% 2 times. On a certain level, that makes sense as the equity market is recovering from a major low, and once a new high is made, the rally continues. But looking ahead, can we expect the new bull market rally to extend into a third year? You know, the year 3 S&P 500 returns from the previous new bull markets had a very mixed record on that regard. The average return was 0%, with 5 positive year 3 results and 5 year 3s that were lower. And in the 5 positive years, the average gain was 7.7%. The average decline in the negative years was 7.6%. And while past performance can't predict future results, in the current environment, we believe that S&P 500 valuations are elevated and that the U.S. labor market is slowing. This creates headwinds for continued equity market gains in our view and should create some caution for investors. Given the history of past new bull market rallies slowing in year 3, we continue to believe that equity investors should scale back return expectations and mitigate risk by remaining broadly diversified across sectors. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.